Welcome back to the Two Stewards Show. My name's Mark, and I'm here with Brent. This is you,
everybody.
Brent. Yeah. And we have another special guest on the show, and this is Ben Rabidoux from Edge Analytics. Ben, how are you?
Good, Mark. It's great to be here. Thanks for the invite, guys.
Yeah, for sure. Glad to have you here. So, Rabidoux, what was that? Is it like Irish or something?
Well, it's funny. It's kind of like a derivative French. So it is French, but it used to be EAU, which made sense. You heard Rabidoux, and everyone kind of understood that's Frenchish. And then they tried to anglicize it and make it OUX, and now nobody knows what to do with it.
That's perfect. We're like a joke to start off the show. So Ben, we know you from I know you from Twitter. Brent knows you from your subscription service, Edge Analytics. Where you analyze is mostly real estate data, right? I mean, I guess more of a macro view with the focus on real estate. Is that accurate?
Yeah, that's by and large, that's correct. So Canadian housing, macroeconomics, and household credit are kind of the big three umbrellas. But a lot of that ends up settling. You can't have a view on the economy without having a view on housing, and obviously you can't have a view on household credit trends without having a view on housing. So a lot of it ends up landing back at the housing space.
Yeah. Okay. Perfect. And so, where did you come from? What's your background in 5 words or less?
Sure. Spun out of, I was teaching at college, had a public facing website. It's going back a decade ago. Ended up with a distribution that was all institutional investors, and realized there was an opportunity to take the website down and turn this into a research offering, and have been doing that ever since. And, there's a service out there that aggregates, or I guess ranks, research providers based on the input from the institutional investors that use the services. And nobody knows who I am unless you're in the institutional investing circles. And then, in that group, I generally rank in the top 5 in Canada, which is generally ahead of some of the big banks and stuff. So nobody knows who I am, but myself and my small team, I think we do pretty good work on this stuff.
Yeah, I sure enjoy it.
That's probably tough to get into too. So I think, we talk to a lot of real estate investors on this show, and we talk about money and economics as well. But I think a common thing that comes through with investors is, okay, they're interested in real estate investing, but every now and then they need a big bear hug, so to speak. Like, how are the trends doing? How is the economy doing? Just remind us that real estate investing might be a good thing. But you're here to talk to us about some statistics. I'm not sure. Is real estate still a good thing to get into?
That's the question. Is it still good? I mean, there's a lot to chew on there.
Yeah. I think that just could give people a bit of a broad picture. I'm interested for myself, especially because, you try to form an investment thesis based on data, like real data, right? But you can be caught up in the month-to-month changes and some of these announcements and stuff. But you really have to zoom out and look at like a 20-year thesis.
Yeah, well, I mean, over 20 years, of course, it's going to go up. Maybe to take a step back, let me kind of sketch a kind of mosaic of what we're seeing right now. If we look across the country, I would say that the prairies obviously look great. So when I look at Alberta, I still see inventory levels in the resale market that are sitting at 15-year lows. You're seeing sales that are still extremely strong, an economy that's robust. That was one of the core kind of table pounding calls from 2 years ago that I was making, and you would know. How long have you been a subscriber, by the way, Brent?
Probably about 2 years.
Okay, so you would remember I was pounding the table like, listen, Calgary, this is crazy. This is
Calgary, by Edmonton,
yeah, less so Edmonton. I'm coming around actually now to saying I think Edmonton's going to be the outperformer over the next kind of year or two. But I still think there's a tremendous value there in Calgary. My call has been for a while now that prices in Calgary would trade back above the national average. So in other words, they would outperform the national average by 30 or 40% over the next kind of 5 to 10 years. And so to me, I still think there's compelling value there. The weak parts that you get into are in kind of southern Ontario, southern BC. And there it's a little bit trickier because you've got these cross currents where you have these extreme affordability constraints that are not so much an issue on the prairies. But you still have very strong immigration. a labor market that is good but is starting to soften at the margins, which we can talk about. Supply that's up off the lows, but is still not back to kind of pre-COVID norms. That's what people realize. We're 2 years into a housing downturn, and there's still not a lot of supply out there. So that's interesting. But I think the picture's a little more mixed when you start talking about those areas. And then to kind of round things out, I think Quebec looks okay. I'm not fired up about Quebec one way or the other. And I think the Atlantic provinces look quite good still. I think there's some opportunities there. So, it's one of those things where people talk about the Canadian housing market, and we sort of forget that we're a market of regional markets, each with its own distinctive supply-demand dynamics. Overlaid on top of that is this high-level, macro policy that's national, for example, interest rates, right? Which I know we'll probably talk about as well. So there's a lot to unpack there, guys. That's a tough jumping off point. Like, is real estate still a good investment? Yeah, depending on it's like how long's a piece of string. It's like, it depends, right? So, where do you guys want to go from there?
Well, some of the policy stuff is, that usually gets the most attention, I think, on Twitter and so forth, with people yelling at the government. But so one recent announcement from OSFI, the Office of, Office of something.
Superintendent of Financial Institutions. Yeah. Banking regulators, we'll call them.
Yeah. Okay.
OSFI.
So they're calling for I think they tried this before and it didn't fly, but they want to do a portfolio wide. And I think so, correct me if I'm wrong, but this is, both for banks and investors, a max 450% income to loan value, which is going to I don't know how many, if you're talking Southern Ontario, that could be like one investment property and that's kind of it, right? Is just because the superintendent says we're going to do this, is it going to happen? And, if it does, what's the effect going to be on investing? Does it just drive people to private investors who aren't regulated by OSFI?
Yeah, so this has gotten a lot of press play, and I think people, by and large, have overreacted to the news. So let's just be clear on what OSFI has proposed. So what they have said is they would like the banks to have portfolio-wide limits on the share of new mortgages that are originated above 450% of loan to income. So in other words, they want to put a portfolio level cap on how many people are borrowing more than 4.5 times their income. Okay, fine. This doesn't come into effect for a year. Okay, so we're talking Q1 next year. This comes into effect. They have not even said what that cap is, so we don't even know yet what the cap is. So everyone's getting all worked up about this announcement. We have no idea what the cap's going to be. So if you look at the data right now, it's only about 12% of new mortgages are above that threshold. Okay. When you then further break it down, like, well, what are the groups that are more vulnerable, less vulnerable? I know everyone's kind of fired up about investors, and I get that, but actually investors, you're only talking about 10% of investors have loan to incomes above that threshold. Who gets hammered most are first-time home buyers, where you've got about 20% above that threshold. So in theory, this could hurt investors. Now, the bottom line is we don't know. We haven't gotten the details. And by the way, OSFI this is in keeping with their normal kind of mode of operation, in that they'll often put out these broad policy umbrellas with no specifics, with a long implementation date. And then what they'll do is they'll sort of feel out the industry about what the industry thinks, and they'll kind of tweak things. And then, 9 months from now, we'll get a policy paper from them that gives more detail. Okay. So for now, we're not talking about an issue for another year. Now, they have not said what that threshold is going to be. They did say it'll be individual by bank. So depending on which bank, some banks will have a higher threshold than others, which is interesting. What I think people are missing, and this is the one thing that could really trip things up, is what OSFI has said is they also want the banks to include all secured forms of debt, which includes HELOCs, and it includes private lending in that calculation. And everyone missed that. That's a big deal, because now, to your point, Mark, if you've got investors that have pulled off a HELOC to buy a second property, or have used private financing to buy a second property, the banks now have to include that debt in their calculations on future loans. And so that could matter more for investors going forward. We just don't know. So the bottom line is you got a year to figure this out. OSFI is going to tinker with the margins. We'll get more clarification as we go forward. It'll tighten things at the margins. I don't think it's a disaster. At least not with interest rates at these levels, because let's remember, interest rates at these levels, like there's not a lot of people borrowing much above 5 times income anyways, because of how high rates are. We get back into a 1% interest rate environment again, like, yeah, this could really tighten things up. But, we're a long ways from that. So a lot of moving parts. I don't know if that answered your question.
You think this is going to hurt first-time home buyers as well then? So you said like 10% of investors might be affected, 20% of first-time home buyers.
Yeah, I think so.
I'm assuming that's who they're trying to help. Or
yeah, well, it's interesting because, that data on what percentage of buyers has those loans above 450%, that comes from the Bank of Canada. But what's interesting is that's looking only at mortgages. That's not looking at HELOC. It's not looking at private lending. So maybe, and I don't know, but I'm just ballparking, maybe if you added those back in, it might skew the share of investors higher. I don't know, right? But if you just take it at face value, the data that the Bank of Canada themselves have put out suggests that this policy is going to disproportionately hurt first-time buyers, which to your point is kind of counterintuitive, which, by the way, is sort of in keeping in line with OSFI's general kind of view of the markets lately, which is that even though we're seeing mortgage debt growing way below inflation and way below wages, so effectively we're seeing a household deleveraging already, they're still keen on tightening things up, sort of like after the horses have left the barn. And meanwhile, you've got credit card debt growing at 13% year over year and surging. To me, it feels like maybe there's less risk in new mortgage originations and maybe more risk in other parts of the market that they don't seem as fired up about. But that's classic regulator behavior. They sort of tighten things after the fact, right?
Well, I mean, I guess, yeah, but if you kind of missed it the first time, at least the second time around, you should probably catch it, right? So is it maybe prudent for them to say, you know what, we're very leveraged in general, and we've seen the pain that's, these interest rate spikes have caused for a lot of investors and even just, regular homeowners. We want to avoid some of that in the future. And if that means people can't get into homes that really they can't afford, then so be it. That's a little bit of what I'm grabbing from what you're saying here. And yeah,
you're right, Mark. It is absolutely, it's meant to be proactive against, if we ever get back into an environment where rates get back to that, 1-2% range, it's meant to limit the buildup in leverage in those periods. You're absolutely right. And so it's a much bigger deal down the road than it is today. I think people are probably getting a little too fired up about it. And frankly, I think there's way bigger policy announcements that were announced last week than this. I mean, this is a drop in the bucket compared to what the immigration minister dropped.
Let's get into those.
Yeah, let's.
I wanted to get that out of the way before we dove into the immigration thing.
Yeah, no, I get it. You'll have a lot of your listeners that would be quite concerned about that measure from OSFI. And if I was them, I'd be paying a lot more attention to what the immigration minister just announced. So, okay. Let me set the stage by saying that, so Brent, again, as a regular reader, will know that my view has been for a while that the immigration boom, let me take a step back. The population boom overall that we've seen in Canada is entirely unsustainable. Okay. And it's built on a very pro-cyclical dynamic. So in other words, because the economy has been strong, immigration has been strong. Okay. So let me explain why that is. Most people understand that Ottawa has a roughly 500,000 PR target every year. So they try to bring in 500,000 permanent residents. And of course, some Canadians leave. So you get a handful of people that move to Costa Rica and are like, I'm not coming back. And so on net, you end up adding kind of 450,000 on any given year. And that's generally 420, 450,000. That's a typical year. But in the last year, we've seen that number balloon up to 1.2 million. And so if your listeners if they're hearing that, they go, well, wait a minute, if the target is 500,000, how do we get to 1.2 million? And the answer is that in addition to the permanent resident bucket, there's also a second bucket that's non-permanent residents. And these are, by and large, international students. They are a lot of temporary workers. And then there's some asylum seekers. And asylum seekers, so there's refugee claimants, they get a lot of attention, but they're actually a relatively small group compared to the other two. That group has absolutely exploded in the last few years. And so for context, non-permanent residents now account for 6.2% of the total Canadian population. We've never seen anything like that. And 2.5 million. And so my point all along has been sort of twofold. First off, so much of that growth is driven by the underlying tightness in the labor market. Okay, so for example, temporary workers have been growing by 190,000 per quarter over the last 6 months. Okay, wow. That's an insane number. Now, that doesn't exist in an environment where the unemployment rate goes back to 7%, let's say, like kind of the long-term norm. So you have to understand that growth in the population is itself a derivative of the strength of the economy. If you are of the view, as I am, that the economy is going to cool because of rates being where they are, then by definition, necessarily, we will not need another 190,000 new temporary workers every quarter. So that has been my call. Yeah. So that's the first point I would make. The second point is you have to understand the politics of this. And here I'm going to get a little bit political. And I want to be really clear. I'm a huge supporter of thoughtful immigration policies. 1.2 million people in 1 year is a disaster. It is absolutely a disaster. And it has all sorts of externalities with things like the rental market being just completely chaotic, right down to basic social services, health, everything just being swamped. Okay, so let's all agree that we can be supportive of the Fed's 500,000 permanent resident targets and simultaneously recognize that 1.2 million is an epic policy failure. Okay, now the polls have turned decidedly against this government over this issue. So it's always amazing how quickly politicians can grow a spine and make tough policy decisions when their political careers depend on it. And that's exactly where this government finds themselves. They're going to lose their jobs over this issue if they don't get their asses in gear and deal with it. So all of a sudden, now you have the immigration minister last week, after several months of sort of announcing, using language like the system is broken, we're losing the integrity of the system. This sort of language that we were hearing for months. So you knew something was coming. Okay, and so what he announced last week doesn't sound like a big deal, but it is a huge deal when you run the numbers. So what he said was, over the next 3 years, we want to get the share of non-permanent residents from 6.2% down to 5% within 3 years. Okay? So when you run the math on that, if you assume that we're going to continue to grow the permanent resident population by 450,000 a year, as we discussed, then to get the non-permanent resident down to that 5% threshold over 3 years, those numbers have to decline by 450,000. So call it 150,000 annually. Okay. So what that means is we are going to go from non-permanent residents adding 800,000 to the population growth in 1 year, which is where we are currently, to a year from now, they will be subtracting 150,000. So if you do your math, that's a 950,000 swing in 1 year. So what that's going to do, if the feds implement this as they're suggesting, is it will take population growth from 1.2 million today to 250 to 300,000 a year from now. Okay, that's a massive change. Now, where it's going to be felt is primarily in the rental market. We will go from a rental market that is chaotic and absolutely crazy today to one that's a lot more balanced a year from now. Not weak necessarily, right? Maybe some pockets where you have maybe a little bit of overbuilding, but by and large, a normal rental market, 2-3% rental growth. Okay, that's going to be a healthy thing. But if you have investors who are purchasing properties today that are cash flow negative and sort of have in the back of their mind, it's no big deal. Once I turn over this one tenant, I'm going to jack the rents up 30% because that's kind of what they've been doing over the last few years. I'd be careful on that assumption because I think rental growth is going to cool. It's still going to go up, but it's going to cool significantly. The other implication related to this, and this gets into the broader discussion around interest rates, is in my mind, there's really no way to cool the population growth to that extent and avoid a recession. Okay, so I am of the view that the economy is heading towards a recession. I think we are already seeing the signs of it. I'm happy to walk through the specific data, but let me give you the call. The call is that right now, if you look at what markets are pricing in, markets are expecting about 75 basis points of cuts this year by the end of the year. Okay, if you look at the projections, first cut coming in June, most likely. That's what markets are expecting. I'm going to take the other side of that. I think they're going to cut probably more like 150 basis points. because I think by the summer, it's going to be abundantly clear that we're heading towards a recession. And I think the Bank of Canada is going to have kind of an oh crap moment. And I expect that by the end of the summer, once it becomes very clear that the magnitude of the weakness that we're beginning to see in the data, the discussion will turn to not whether we need rate cuts, but whether 25 basis points at a time is going to be enough, and whether maybe we need 50 basis points in the October and December meetings. That's where I think we're going. And all of that is tied up with both the slowing population that we're going to see within a year. That's tied up in already the very weak data that we're starting to see come in that to me points very definitively towards recession. So there's a lot there. You guys can take that wherever you want.
Yeah, there's a whole bunch of things. U.S. rate cuts versus Canada is a D to our dollar. But okay, so we've been talking about immigration and a lot of the same things on this podcast in a similar way, and it's good that people can actually have a mature discussion about it now without being called racist, because that's, I think, a year ago you wouldn't even be able to say this because immediately they would sick the dogs on you.
Bang
right?
on, Mark. Yeah, bang on. I was like the OG on this file. Like just to frame it for you guys, I was the guy so I was testifying before the Standing Committee of Finance in 2022 over this. Yep. And at that time, I was already getting DMs on Twitter being like, dude, you can't say that. I'm like, what do you mean I can't say it? This is an issue. And if we don't address this, like the risk, Mark, to your point, right? We've seen so much pushback against thoughtful discussion around immigration policy. And what worries me and what Canadians should be worried about is we have seen so much benefit from having thoughtful immigration policy for so long, from attracting the best and the brightest here. And if you do stupid things like run the population up 1.2 million in a year, the average Canadian does not understand the distinction between non-permanent residents and permanent resident targets. To them, it's just immigration and it's too much of it. And they're not wrong. And so now you run the risk of having ordinary Canadians turn against immigration, right? And that could take a generation to change if we're not careful. And so you run the risk of stoking anti-immigration policies by not being thoughtful. And that's what's at risk here. So I agree 100% with you, Mark.
Yeah. So,
and if people turn their backs on immigration, like, doesn't Canada need immigration to boost their economy? Like, that's kind of the story, right?
No, we do. I agree with that. And that's not all of that's correct. And I think, again, to get back to it, there's not too many people that would push back against the idea that we need some level of permanent immigration. The 500,000 PR target. You can have a discussion whether that's too high, too low, like at the margins, but by and large, the principle it makes sense, and I think people by and large support that. And but you're right, like you're running the risk of stoking this anti-immigration sentiment and having it sort of be lost for a generation and losing kind of one of our superpowers as a nation. And that's what the people who are supportive of immigration don't understand, right? And when you push back on people who are trying to have thoughtful discussions over this, you are sowing the seeds for anti-immigration sentiment, because all you have to do is open your eyes and walk around and see the rental crisis and see the shortage of social services and see temporary international students sleeping under bridges and temporary workers being taken advantage of and suppressing wages for ordinary Canadians. Like, all of this crap is bad. And to push back on any discussion about immigration is just foolish,
Yeah. Yeah, I mean, and I've voiced my concerns about, we need immigration to keep GDP up. And it's like, well, yeah, look at GDP per capita, et cetera, right? Like, can't we just have more babies? I know not everybody's going to do that. So, but someone might look at this and say, okay, you're talking about non-permanent residents, Ben. Like, what's the big deal? They're non-permanent. They're going to go back. It's not like they're staying here, right? These students, they're coming here, they're getting an education, and then they're going back to their country to better their lives. Isn't that right?
Well, I think you need to be careful. So, all right, this diverges into a second discussion that's sort of parallel to this broader discussion of immigration. So, one of the reasons why when temporary residents grow very quickly, it necessarily slows overall population growth in the future. Okay, and let me explain why. This is, again, getting a bit in the rabbit hole. But if you come to Canada via several of these pathways as a temporary worker or as an international student, there are a number of programs that effectively fast track you for permanent residency. Okay. Now remember, the feds have a permanent resident target of roughly 500,000. So if you're already here in Canada and you're counted in the population as a temporary worker, excuse me, and then you get your PR status, that's one fewer PR slot that can be given to a actual newcomer. Do you understand what I'm saying?
Right.
Basically, what you're doing is you're taking somebody who's already here and you're just shifting them into the PR bucket. And so you're right, Mark, a lot of them are intending to stay. That's fine. That's great. We want the best and the brightest of that cohort. You can't have it both ways. If you run up the non-permanent resident cohort now, it means fewer newcomers through the PR channel in the future. That's one thing. The second thing related to that, and one of the things that I worry about a lot is, okay, this whole issue with international students and some of these private-public partnerships. I don't know how much you guys want to go. Let me just vent here for one minute. Give her. One of the disastrous policies that we've allowed here in Canada is we've said to colleges, we'll effectively rubber stamp international student applications. Okay, no limit. However many you want to bring, just go for it. The colleges in turn entered into private-public partnerships with for-profit entities. So they license their degree granting capabilities to for-profit entities. So Mark and Brent, you guys tomorrow could start up a college, rubber stamp it from an actual academic institution. You can then hire marketers to go over primarily to India, by the way, which is the number one target market.
We were going to do that after we started a bank. So
yeah, no, this is way more lucrative. Do this first. Less regulations.
Do this first.
and you could have these marketers go over and tell these kids anything. You could tell the families, listen, if you send your kid here and they get their degree, then they can bring everyone here and it's a new life. And so now you have these kids whose families have mortgaged the farm and pooled their savings, done everything they can to send their kid here. And they're expecting, they were told that their kid was going to get PR and that they could then come with them, right? It's not going to happen. We've allowed marketers to make a ton of false promises on behalf of the government of Canada. Now you're at a situation, once you think about this, we have 2.6 million non-permanent residents here in the country. They skew significantly towards males. Okay, so it's probably 2/3 men. And you're going to have a lot of very angry non-residents in this country who have been told given false promises and are going to be, frankly, pretty pissed. It looks to me like that's a national security issue. And I don't know how we get around that. And we should be blaming the marketers that were making these promises overseas, the recruiters, on behalf of the colleges and universities, as well as on behalf of businesses looking for cheap labor. All of them are culpable for this.
Yeah. So the reality is they're going back eventually to wherever they came from, and they're spreading that same message there, warning people. I'm guessing that's how it kind of goes.
Well, I don't imagine they're going to go back quietly. Like that's the problem, right? Yeah. So in theory, you're right. The non-permanent resident programs are meant to be non-permanent. You come here on a temporary basis, and then most of them will leave, and a small group will then be transitioned into permanent residency via a number of programs. That's great. That's how it's meant to work. Instead, we have a situation where we've sort of overpromised and now have to underdeliver. Okay. And so, yes, you can give everybody that's here permanent residency. That's fine. But just remember, that's one fewer new permanent resident that can come for each person that you give that PR status to that's already here. So the 2.6 million, just for context, if we want, we can hit our 500,000 PR target for the next 5 years just by giving those folks permanent residency, and the population won't grow by one person.
It just stays the same.
It just stays the same. So you'll hit your PR target, and all you're doing is shuffling between two categories, right? So I don't know what the answer is here. We've allowed promises to be made. We've allowed people to sell citizenship in Canada for profit, and we can't deliver. And so now, I don't know what the answer is, but it's very clear to me you're going to have some people very pissed off over this.
Yeah, I mean, again, so I asked you that question a little bit tongue in cheek, but
I vote for Ben.
Oh heck no, zero chance. I want to take this on. Pity the person that's tried to untangle this mess.
Oh man, but yeah, it is a shameful situation because if you didn't know, if you're in government and you didn't know this was going on, you should have. right? There's statistics to show how many people are coming in, and you didn't have to dig very far on social media to see like these tragic stories of student suicides because they knew things weren't going to work out here. They come here and like you can't afford to live, can't afford an apartment. And then just the outright scams, right? The promise, the labor market permits that it's a whole industry, right? Companies 100%. Are involved, colleges are involved.
That is exactly right.
People.
It's totally become an industry. Yep.
And so Ben, what about linking this back to real estate? So what's the narrative here? Like fewer non-permanent residents? Does that means fewer tenants, lower rents, like you've kind of highlighted, right?
Well, not lower rents. No, I want to be clear, Brent. I'm not saying lower rents. I'm saying the rate of growth will slow, which is different than saying that it's going to decline. Okay. So rather than getting 10% rental growth a year, we'll probably go back to 1%, 2%, 3%, which is frankly where it should be. And that's a little more manageable. Yeah. Okay, what it means for real estate. So let me very clearly draw the distinction between single family and multifamily here, because Brent, you'll know my work. When we look at, for example, single family building permits across the country, they're at really scary levels. We are not, we're back to 1980s levels of single family building permits. There's
scary low,
right. And, we're in this weird situation where like the real estate market's squishy because demand is kind of soft because of rates, but like eventually everything's cyclical. Eventually you're going to get back to a normalized demand environment. I worry that when that happens, that's going to happen into an environment with very, very low supply of single family. And so I would set that aside. I'm not concerned. I think if anything, we are still looking at a major supply crisis of single family, not this year, probably not next year, but beyond that, absolutely. When you look at the numbers, scary. I would definitely draw that distinction when you get into multifamily, because you look at what's under construction. You have almost 150,000 purpose-built rental apartments across the country under construction, by far a record high. You've got another, 160,000 condos, half of them typically enter the rental pool at completion. So you got somewhere around 220,000 kind of de facto rental units coming online in the next year and a half, 2 years. That's a fair bit. That's not a small amount. And it's going to come at a time where, the demand side might be a little squishy. It's hard not to see that being sort of just a less favorable environment for a period of time. Again, not a disaster, but let's just be real. Like if you were banking on 10% rental growth to break even in a couple of years, you're probably going to be disappointed. But to me, that's what that means. And you can also look across the country and you can see the pockets where it's potentially going to be more problematic than others, just based on the buildup in those what's under construction.
So if the rental market kind of goes back to normal levels, do you think we'll see more houses being sold? Like I think you kind of alluded to this, that, if I'm an investor, I own a property and I can expect my rent to jump significantly, I might be tempted to hold on to the property rather than sell it. But there's probably people out there that are holding on, waiting for rents to go up. Yeah, might end up selling.
So I've made the point that, and again, this is hard. It's hard to pin this down exactly for projections purposes, but you sort of know this dynamic is happening. Okay, so what I've suggested is definitely a strong rental market is added to demand, including for single family. Okay, and the reason is, if I buy a single family home, there's zero chance I can cash flow it by renting it to one family. But if I'm willing to jam 10 international students in there, all of a sudden, charge them $500 a bed, all of a sudden I can make some real cash flow, right? By the way, that's horrible. I'm sorry, and I understand that that's just it's a derivative of just how tight this rental market has been, but that shouldn't be happening. It is happening. It's been a real thing, and so to the extent that we can get rid of that dynamic, that should reduce some of that demand for single family. Again, it's marginal. It's not going to move the needle much. Where I think it could matter a little more is, one of the things that's kind of been confounding to me, and I've written about it, is if you look at new listings in Toronto, they really fell off a cliff starting in 2022, right in line with when the overall resale market weakened. And I kind of have a thesis on that, in Canada, we've gotten very used to short, shallow housing downturns. And so as long as you don't sell for 6 months to a year, prices will rip back and you'll get your highs. Okay. And so I believe that we've seen a lot of people pull homes off the market that would have been sold if the market was still reasonably liquid. And so then you say, well, where did they all go? Well, if you then look at the rental listings on the MLS system, we're sitting at the highest level we've seen in over a decade. I mean, it looks like a hockey stick. It's pretty flat and it just jumps up. So to me, I think you could make the case that some people who would otherwise have sold, whether it's second property, maybe they've moved to during COVID, they moved to smaller towns or whatever. They held their homes in Toronto. They're probably feeling the pain from having rates gone up on them, but they're saying, I don't want to really sell it for $200,000 less than it was worth at peak. Maybe I'll just hold it and rent it. By the way, the rental market's crazy strong, so what do I have to lose? Well, now if the rental market starts to soften a little, I think you could see a scenario where some of that inventory that's on the rental market begins to transition back into the resale market. And that would be helpful because, as I said at the outset, we're still at a level of inventory nationally. It's about 35% below kind of normal levels. So we have a ways to go to actually, get some supply on this market. And that both of those dynamics, I think, would be helpful.
Does this dovetail with rate cuts then?
The population thing specifically?
Well, this whole, so if you have a lower non-permanent residents and the rental market kind of, slows down a bit.
Absolutely.
And people decide to list, okay, well, Canada relies on real estate, right?
Well, okay, so
in a big way.
What I would say is, so right now, so headline inflation was 2.8% year over year last month. 0.5% of that was just rents. Okay, so that's a lot, right? And then you have another 0.8% that's mortgage interest costs, which is a weird thing that mortgage interest gets included in CPI, but it does in Canada. If I'm right and the rental market starts to cool, that 0.5% growth in rents, like how much that's adding to CPI is going to decline significantly next year. That's one thing. But then the other thing I would point out is you got to remember we've had now 5 straight quarters where GDP growth has been negative in real terms. In per capita terms. So in other words, all of the GDP growth that we're seeing in the country is not due to the fact that we're more productive. It's due to the fact that we're just adding more people. And so if population growth slows, necessarily, if you assume productivity trends continue the way that they are, it's recessionary. And that's not even getting into the data that I think already points to the fact that we're heading towards a recession. It absolutely, it feeds into the rate cut expectations for later this year and into 25, I think.
So you say we're heading for a recession. Yeah. Are we in a recession? We just don't know it. Like I'm looking at some of the, you don't think so? Okay. I don't know if you have a comment on like employment data, right? Latest employment data is showing private. What's that?
I got a lot to say about employment. I got 5 minutes. How about we do this? Let me run with this just for the sake of time. Let me outline why I think we're heading for a recession. Okay. For the sake of you, I know where you're going with the question mark, so I'll just jump in. So, so in Canada we have 2 different labor surveys. One is a household survey where they literally call a bunch of people and they're like, "Hey, did you lose your job? Can we talk to you about it?" And naturally, that's going to be less. The quality is going to be not as good, right? Because a lot of people are like, "Man, I just got fired. I don't want to talk to you guys about it." You know what I mean? Like, you click. Versus, that's one data series, and that's the one that everyone looks at. That's what we call the labor force survey. Comes out the first Friday every month. Gets all the attention in Canada. It's a garbage survey. I'm sorry. It's just, I shouldn't say it's a garbage survey, but it is so volatile that it's almost useless. Okay, let's just say that. That's one data series. Second data series are the payrolls, and that actually draws from payroll remittances by businesses. So when businesses file their taxes every month or every quarter, they have to state how many employees were on payroll. Well, that's a lot better quality data than picking up a phone and being like, "Hey, do you still have a job or did you get fired?" Right? And for some reason, no one pays attention to that in Canada. They do in the States. Payrolls get all the attention in the States. In Canada, we focus on this household survey. And the reason I mention that is because right now, those 2 employment trends are diverging. Okay. And so if we look at private sector payrolls, they are now declining on a 6-month basis at the fastest rate since the financial crisis and since COVID. Those are really the last 2 times in the last 20 years that we've seen private sector payrolls declining like this. That's one thing. Look at business insolvencies, absolutely spiking. And Brent will know this, my call for the last 2 years is business insolvencies will lead consumer insolvencies this cycle for a number of reasons we get into. But we're seeing the business insolvency spike. You cannot have this many businesses going out of business and not have it show up in the employment numbers in due time. So we're starting to see that. In addition, you're starting to see signs that consumers are pulling back. You can see it in the retail sales numbers. Again, when you look at it per capita, you can see it in Canadian Tire quarterly earnings, Leon's Furniture quarterly earnings, like all of these consumer retailers that skew more towards discretionary spending. All of them are seeing soft sales. And so to me, it's indicative that the overall economy is much softer than people realize, and I would say is softer than the Bank of Canada is willing to recognize right now. But I think they'll be forced to recognize this because you roll these trends forward another 3 months or so, I think it's going to be patently clear that these rates are not working for the Canadian economy.
But still not recessionary, like you would say.
Well, but you got to be careful, Brent. So the way that recessions work, remember, they're assessed after the fact. Okay, right. So there's the board that gets together, and remember, it's in theory the definition is 2 quarters of declining GDP growth. Okay, fine, but really it's more nuanced than that. It gets to do with the state of the labor market, and really people assess whether it was a recession 6 months after it's ended, right? So, in other words, you're not going to know that you're in a recession until at least 2 quarters after the recession started. So I don't think we're there yet. What I would say is you're seeing the early signs that things are tilting in that direction. But I think within 3 months, it'll be clear that we're heading in that direction. And by the end of the year, the Bank of Canada is going to be in oh crap mode. That's what I think. And again, I could be wrong on this, and I've been wrong plenty of times. And this is a weird time to be making calls on the economy because there's a lot of weird things happening and cross currents. And so there's a lot that could make me wrong on this. But when I look at the data, this is where I land for right now.
Yeah, and you highlighted like the decrease in private sector payrolls and stuff. I'm wondering what the public sector payrolls look like.
Well, that's a little different. They still look okay. They still look okay, but they're starting to soften too. There's only so long you can play that card before ultimately you need private sector.
Well, when does that blow up? They just keep printing money. I don't know.
Yeah, well, that's fair. Yeah, but I got to think about that.
We're looking at some of the jobs data.
Yeah.
Jobs data, and then we have all these new jobs in the public sector, but not in the private sector.
Yeah, but I'm thinking, I got to go back and look at the data, but I think even inclusive of public sector, it's still flat to down over the last 6 months on payrolls.
Yeah, it's not good.
Yeah. No, it's not. Either way, it's not great, but it's very clear when you look at private sector, right? And ultimately, I mean, yeah, you can play that game for a while. You can keep hiring public sector employees for a while, but you do need the private sector to ultimately drive growth over the longer term. It's just not sustainable any other way.
Yeah.
So I've been. I know you got to run soon, here, Ben, but maybe one more question. I don't know, a little bit of prediction. So I've been seeing some calls in the U.S. that maybe rate cuts aren't coming so much in the States, and I know trying to predict is that's a tough business. But I mean, if they don't cut so much in the States and we end up cutting here, is that going to exacerbate our recession, do you think?
Okay, so this is something I was worrying about 5 years ago. Well, one of the concerns, and if you think about a nightmare scenario, it's that the Canadian economy starts to soften dramatically, but the Bank of Canada is backed into a corner for exactly the reason you suggest, which is that the U.S. Fed cannot start to cut yet. We're starting to see that. Now, the reason why we're seeing that is if you look at in Canada, we're much more indebted relative to GDP, for example. In the U.S., they went through a financial crisis. They paid off a lot of debt. They defaulted on a bunch of it, so it kind of cleansed it out of the system. So household balance sheets are actually in really good shape. The debt servicing ratio is at the lowest on record in the U.S., and here in Canada, it's the highest on record. So you got literally the opposite dynamics. In the U.S., households can lock in their debt for 30 years, so they're protected from these high rates. They're not feeling this at all. Same is true for businesses. You only have about a quarter of business debt that's floating rate in the U.S. It's much higher in Europe and Canada. We don't have the deep liquid capital markets that they have there. So for a number of reasons, the U.S. is far more insulated from high rates than Canada is. And then in addition to all of that, they're running these monster fiscal deficits, even way worse than Canada, and look like they're set to for several years. So you can't underestimate how stimulative that is for their economy. So for all of those reasons, it's hard to get to a scenario where the U.S. Fed is going to be super hawkish, dovish, wanting to cut. But you can easily get there with Canada and soon. And so you've hit on the one thing I'm really struggling with, and I don't know how this is going to play out. But I think that what we're likely to see is the Bank of Canada is going to have to cut. They will cut, but they will ultimately be constrained in how far they can go. And so that gets back to this concept of like higher rates for longer. So are we going back to zero? Like probably not, but could we pretty quickly get back to 3% overnight rate? Yeah, I think so. But then much beyond that, they really have to weigh out the risk of seriously damaging the currency. Because if the U.S. Fed stays where they are on rates and the Bank of Canada tries to cut meaningfully, you're going to have the Canadian currency go back to 50 cents on the dollar, on the U.S. dollar, which means it's great for exports, but you're going to have another issue with inflation because now everything that we import into Canada is going to get much more expensive. So I don't know how that dynamic plays out, but you are absolutely right, Mark, that that's going to act as a limiter on how much the Bank of Canada can drop rates. I think that's a much bigger discussion come 2025. I think for this year, it's going to be a bit of, oh crap, as we get toward the back end of the year and realize that the economy's tilting towards recession. Beyond that, it's going to be a much bigger discussion as to how low we can go before we decimate the currency.
Oh man,
well,
yeah, it's a pickle. It is totally a pickle. Yeah.
All right, Brent, you got anything else for Ben where he flies?
No, I think you gave us a good bear hug for now.
Is it a bull hug or a bear hug?
That thing's oh man, yeah. We just have this joke that it's every now and then with investors in the market, they're like hearing the news, they read the headlines, they're like, "Wait, what a minute! Like, what am I doing with this investment? I got to sell it." It's like, "Okay, no, wait, think, look, 20 years ahead."
Yeah.
So for your perspective, just to kind of wrap up, like the long-term view of kind of investment landscape in real estate in Canada, like. Yeah. How do you look at this? I mean, you're looking at data all the time, monthly changes and stuff like that. Like, do you take the time to zoom out and look at, 20, 30 year timeline and what that looks like?
I mean, for my purposes, I can barely, I don't have a lot of visibility on what's going to happen next month. And the predicting business is crap business. So the idea of predicting much beyond the next couple of quarters is pretty daunting.
Yeah, I'm just thinking like a thesis, right? Like kind of.
Well, listen, if your thesis has been that prices are going to go higher over time, it's hard to argue against that. Yeah, no question. You're talking like a 20 or 30 year time horizon. Yeah, of course, pricing. Input costs are not going down, right? You ask any builder, they're not like, hey, things are, outside of land, the raw price of land is going down, but everything else has been going up for a lot. So yeah, it's hard to get to a scenario where prices are going to be down over a 10 or 20 year period for sure. And especially for single family, given what's happening on the new supply front. So beyond that, I mean, I don't know how cute your listeners want to get in terms of how tactical they want to be, but yeah, I think you probably have a buying opportunity. Like, I think seems a reasonable chance. Like, I don't know how this recession is going to play out because yeah, rates are going to come down, but people are going to lose their job. The economy is going to cool a little, and that's generally has not historically been great for real estate either. So, I would be inclined to think there's probably more of a buying opportunity coming. If I was looking at single family, if I was looking at upsizing or whatever, or getting into the market for single family, I would say you probably have a narrow window, right? The next year, maybe you got some softness in pricing. But again, that supply picture looks really daunting beyond that. And so, I would be much more kind of bullish on that segment. Multifamily, I think there's probably a bit of softness for a while. Like, I think you could get a scenario where condos are going to just kind of grind for a while and look pretty squishy. Even rentals, we're probably not, again, the pricing, the rental growth is not going to be what it was before. There's a fair bit of new supply, but I'm not calling for a disaster by any means. I just think that there's probably buying opportunities before things turn around. So that's the best I can do. And I'm always leery giving anything that gets close to personal financial advice because, who are we talking to here? Are we talking to some kid who's just graduating university? Are we talking to some, 50-year-old, multimillionaire who's looking at growing his portfolio? Like, it's impossible to give these kind of blanket, pieces of advice for everybody. So I'm really hesitant. So I speak in very broad generalities when we get to that stuff.
Yeah, absolutely.
We can appreciate that.
So, Ben, how can people, follow you, get your content, all that kind of stuff?
Sure. Well, you can follow me on Twitter, so at Ben Rabidoux. And I don't know if you guys will link to that or whatever. The newsletter, if you are connected to the real estate space in any way, developer, realtor, mortgage space, you can check out edgeanalytics.ca. $30 a month, you get marketing infographics, you get conference calls, you get research that is institutional quality. Brent reads it, so
yeah, it's good. It's good. We'll get some listeners subscribed.
Yeah, so it's all there for you, and then you can sign up for a month for free. You don't get charged. If it's not your thing, I'm easy to fire. So there's that. If you're on the institutional investor side, you got to reach out to me through my institutional space, which is North Cove Advisors. So
that includes predictions, right? You got predictions, crystal ball.
Yeah, for what they're worth. Yeah, you get the predictions, but it's my crystal ball works exactly as well as anyone else's.
Yeah. Do you have a tracker on like your predictions, whether they're true or false after so many years? You kind of keep.
That's a good question. I should. In my mind, it's funny how like bad predictions, you kind of forget those and you remember the ones that you got right over time. So probably, there's plenty of both, man. I've gotten lots of calls right. I've gotten plenty of calls wrong. So it is what it is. That's the nature of the prediction business.
I'm sure there's plenty of people to remind you of the bad ones and not the good ones.
Oh yeah, absolutely. You get lots of them.
So Ben, we appreciate your time with us today, man. And it's been good. It's been insightful. And we'll have you back on in 2025 when things fall apart. So
let's do that. Let's schedule a time to catch back up, and we'll go over some of these predictions, see what happened.
Yeah, there we go.
Yeah, all right. Thanks, Ben.
So to our listeners, thank you for listening, folks. Hope you found this, informing and a little bit entertaining. And until next time,
steward your wealth wisely. Thanks for listening to this episode of the Two Stewards Show. If you like my voice better, click subscribe.
And if you like my voice better, click share.
If you like both, give us a 5-star rating.
To interact with the show, feel free to reach out at hello@twostewards.ca.
We'll see you in the next episode. In the meantime, steward your wealth wisely.